All right, let's dive right into this explainer and tackle the absolute ultimate question every single investor asks at some point. Is it actually possible to outsmart the financial markets? Today, we're going to explore the really fascinating world of market efficiency, look at its core definitions, and figure out what it truly means for your own investment portfolio. We constantly hear these loud, flashy stories about Wall Street gurus making millions, and it's honestly so easy to get caught up in all that hype. But we really have to stop and ask ourselves, do these folks possess genuine, repeatable skill? Or are they simply getting incredibly lucky in a massive, highly random system? It's a debate that literally lies at the very heart of investment valuation.
I absolutely love this quote from Oscar Wilde. It perfectly captures what we in finance call the bigger fool theory of investing. It highlights the absolutely crucial difference between the market price of an asset and its true underlying value. Because look, investing shouldn't just be about hoping a bigger fool will come along and pay a higher price for it tomorrow. It's about fundamentally understanding what an asset is actually worth.
So here is our roadmap for the explainer today. We'll start with 1. What is market efficiency? 2. 3 levels of efficiency. 3. How markets correct themselves. 4. Implications for your portfolio. And 5. Does valuation still matter? Let's get into it.
Section 1. What is market efficiency? Decoding the financial jargon. Okay, so an efficient market is basically one that provides an unbiased estimate of value. Now, what does that actually mean in plain English? Well, it means prices aren't always completely 100% perfect at every given second. But, and this is key, the errors in pricing are entirely random. There just isn't a predictable, exploitable pattern to them.
This right here is the biggest misconception out there. People think efficiency means prices perfectly equal true value instantaneously. Nope. The reality is that pricing errors are completely random. You just can't systematically predict whether a stock is overvalued or undervalued based on some simple formula. There's literally an equal chance of a stock being mispriced in either direction.
Moving on to Section 2, 3 levels of efficiency. This is known as FAMA's classification.
Notice how the available information is kind of layered here. In weak form efficiency, your stock charts tracking past prices, totally useless for finding a bargain. Step it up to semi-strong form, and reading a company's public financial statements won't give you an edge either. And if a market reaches strong form efficiency, well, even illegal, private insider information is already baked into the price. So, depending on the market's level, trying to dig up data to beat it might just be a fool's errand.
All right, Section 3, how markets correct themselves. Let's look at the self-correcting machine.
It is kind of a mind-bending paradox, really. Think about the steps. Step 1. An inefficiency, or mispricing, appears. Step 2. Millions of greedy, profit-maximizing investors spot it. Step 3. They trade aggressively to exploit it. So, markets only become efficient because these investors actually believe they are inefficient. Their constant, relentless hunt for bargains is the exact engine that drives prices right back to their true value.
Take a look at the relationship between ease of trading and inefficiencies. Finding a genuine bargain on a highly liquid stock like IBM, where millions of shares trade instantly, is incredibly difficult. But compare that to trying to find a mispriced piece of local real estate. There, trading is slow and transaction costs are massive. Makes sense, right? As costs go up and trading gets harder, inefficiencies are much more likely to stick around.
Which brings us to Section 4, implications for your portfolio. Time for a reality check.
Okay, if the market is highly efficient, here are the gut punch realities for active investors. First, indexing, or randomly diversifying across a wide range of stocks, is generally vastly superior to trying to pick individual winners. Second, frequent trading is actively destroying your wealth through transaction costs, period. And third, paying for expensive equity research often simply doesn't pay off. In an efficient market, honestly, you're frequently better off buying a low-cost index fund and doing absolutely nothing.
But you've got to keep this surprising statistical fact in mind. Because pricing errors are random, approximately half of all investors will beat the market in any given period prior to transaction costs. But remember, this is largely due to random chance. It's basically a coin flip. It's not necessarily because they are some sort of undiscovered investing genius. It is absolutely vital to separate luck from genuine skill when evaluating performance.
And as you'll see here, the valuation approach you choose Whether that's relative valuation or discounted cash flow models entirely depends on your specific assumptions about how quickly markets correct their mistakes. If you think the market corrects over a long horizon, you'll lean one way. If you think it's mostly right on average right now, well, you're going to lean another way.
Finally, Section 5. Does valuation still matter? Let's open up the Skeptic's Toolkit.
The most powerful stance you can take here is to adopt the mindset of the wary skeptic. Always start with the presumption that the market price is correct. Before you decide a stock is incredibly cheap or wildly overpriced, you need to demand overwhelming evidence from your analysis. Having this higher standard acts as a safety net. It protects you from your own biases and the illusion that you somehow always know better than millions of other traders.
So how do analysts actually test these theories? They use things called event studies. They carefully track the exact announcement date of new information, like a big earnings report or a merger, to see if the market price adjusts instantaneously and without bias. In a truly efficient market, that price jump happens the exact second the news hits. That leaves absolutely no window for an everyday investor to easily profit.
Now, by measuring these return windows around events, researchers have uncovered some pretty strange anomalies over the years. We're talking patterns like the January effect or the small firm effect. But here is the ultimate catch. Exploiting these anomalies on a piece of paper in some academic study is very, very different from making real money in a brokerage account. After you pay all the bid-ask spreads and trading fees, the friction of reality often totally erases the theoretical profit.
I'll leave you with this final, incredibly provocative paradox to ponder as we wrap up this explainer. We know markets become efficient because active investors are tirelessly hunting for bargains, right? But what happens if everyone completely gives up, just buys passive index funds, and stops trying to find undervalued stocks? Who or what is left to keep the market efficient? It's a fascinating question that literally keeps financial theorists awake at night. Thanks so much for joining me for this explainer. Keep questioning the consensus and stay curious.